Do you still think DR levels don't matter for market algorithms? These trades from last week with pinpoint to the tick rejections will change your mind. Number 7. Euro FX Futures Monday Regular DR Session Trade. Let's start with Monday's regular DR session on the Euro FX Futures. The RDR formed and closed as a grey DR box, which is defined by the opening and closing price of the defining range being equal. At 10:35 a.m., price confirms shorts with a higher probability for the session, shifting our focus towards short setups. As I've shown in previous videos, we look for other confluences like volume imbalances, intraday gap imbalances, and previous DR session levels to increase our probabilities. Looking at the session, there are some WIBs created right before and during the defining range formation and an intraday gap imbalance to consider. In terms of previous DR session levels, the ADR levels also showed strong rejections at the defining range highs. These to the tick rejections must be random, right? A few moments later, price retraces back into the defining range and shows clear rejections from the volume imbalance that aligns with the aftermarket DR session lows. There's plenty of time to find an entry here, with your stop loss covering the intraday gap imbalance and IDR mid. We are looking at a solid 3R setup, targeting the low-hanging fruit of plus 0.5 standard deviation, and there's no need to bother with pushing for lower prices. 3R is completely fine here. The price action on the Euro FX futures chart is simply lovely. A quick look at the spot market price chart shows similar behavior, but you'll notice some differences. For example, the DR box is green on the spot market with the closing price slightly higher than the opening price. Additionally, you would have missed out on some of the volume imbalances as well. This shows why cross-referencing with futures charts is so important. Number 6. Light crude oil futures Wednesday regular DR session trade. Let's break down Wednesday's regular DR session on the crude oil futures. The session closed as a red DR box and shortly after confirmed shorts with a higher probability throughout the session by closing below the defining range on a 5-minute time frame. When looking at all 3 DR sessions, they indicate a trumpet-like price action behavior, where both sides of the market could be played throughout the rest of the day. This type of price action suggests lower probabilities for further downside, but since we don't have any guarantee of a complete trumpet formation, we'll proceed as usual by highlighting volume imbalances and intraday gap imbalances. There is one open magnetic volume imbalance signaling a potential return back into the defining range right above the IDR low, along with some previous WIBs created during the defining range formation. In terms of intraday gap imbalances, there is one from the previous DR session that also aligns with the current defining range. Lastly, let's check if there are any previous DR session levels that align for potential setups. We have the previous day's RDR high and the previous overnight DR session lows, which I've highlighted here. Price retraces further, reaching the 1 standard deviation level. More interestingly, it takes out a significant low in this area, which lowers the probability of high-quality trade setups for the session. Price then finds its way back into the defining range and shows multiple rejections from the IDR mid in combination with previous WIBs. This is a good signal for your first bullet, where you can enter with your stop loss at the beginning of the retirement setup area, targeting either a new low or the next standard deviation level. Price drops lower, hits the IDR low, and then retraces higher, resulting in a stop out. At this point, price is not only in the retirement setup area, but it is also rejecting the previous DR session levels and the intraday gap imbalance. This presents your second bullet for the session. Price fails again to go below the IDR low, which is the red dashed line. As the session comes to an end, the position is closed. While the potential setups might have looked appealing, the overall picture across multiple DR sessions indicated low probability conditions, leading to 1 loss and 1 break-even trade for the session. Number 5. S&P 500 Futures Market, Thursday Regular DR Session Trade. Let's take a closer look at the Thursday Regular DR Session on ES. The session closed as a red DR box, and interestingly, the overnight DR session lows had not been violated, signaling something important. The relationship between all 3 DR sessions suggests that a DR upside model is still intact, where all sessions have respected the previous DR session lows. With that in mind, we'll need to wait for a confirmation in either direction before taking any trades. About half an hour later, price confirmed shorts with a higher probability throughout the session in line with the red DR box. Let's return to the DR model. What do we have here? The confirmation candle has violated the overnight DR session lows, breaking the DR upside model. This shift allows us to focus on potential short setups. In terms of WIBs and GIBs, we have a beautifully clustered area at the top of the current range, offering potential confluence for a setup. Looking left into this week's price action, we also see a lot of previous DR sessions lining up, adding extra strength to our analysis. Now that we're prepared, we wait for a retracement. Price retraces aggressively, showing no reaction from key levels like the IDR low or mid, and reaches into the retirement setup area. In this case, your stop loss doesn't need to go above the defining range high because there is a large gap between the DR high and the IDR high. Instead, focus on placing your stop 3 ticks above the IDR high or at another significant area, like in this case the previous DR levels. Unfortunately, a potential trade here with all the key areas covered by your stop loss would only reward you with a 2R, which isn't ideal. So we skip the trade and wait for higher prices. A few moments later, price retraces further, and this time you're already prepared because you've highlighted these areas in advance. This is your high probability entry. You now have a DR upside model broken, a red DR box, a short confirmation, a retirement setup, WIB rejections, and previous DR levels being rejected. Price returns several times back into the intraday gap imbalance and finally drops lower. Almost at the end of the session, price reached the low-hanging fruit target of plus 0.5 standard deviations. Now, are you starting to realize why DR levels are so important for market algorithms? Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit m7er.com for more information. Number 4, light crude oil futures Thursday overnight DR session trade. Does this aftermarket DR session to overnight DR session constellation look familiar? If you've been following the top 7 trades of the week videos, you'll recognize this setup. We've seen this exact pattern unfold across multiple assets, and last week it happened again in the light crude oil futures market. Let's break it down. The overnight DR session closed as a green DR box and confirmed longs right after. However, looking at the relationship between the ADR and ODR, we can clearly see that a DR downside model is still intact. Ideally, you'd want to see a red DR box followed by a short confirmation to increase your probabilities by trading in the direction of the DR model. But in this case, we still have plenty of room to the upside, so we need to be cautious with our target selection. As I've shown in previous videos, the ADR levels remain important, and the higher you aim for your targets, the lower your probability becomes. If the overnight DR session breaks all ADR levels, the likelihood of turning into a range expansion model increases. Inside the defining range, we have one open magnetic volume imbalance, while another one has just been rebalanced. Also, the previous day's RDR lows align with the current defining range, providing extra confluence. Now that we're ready, we wait for a retracement back into the DR. Price pushes higher, reaching the ADR lows and ADR mid with its extension before finally retracing back into the defining range and into our critical levels. It rebalances the open volume imbalance and rejects the previous day's RDR lows to the tick with the candle bodies. The retracement back into the DR also left two open magnetic volume imbalances that increase the likelihood of seeing upside price action as well. This is your entry point, and aiming for a new high offers a potential reward of more than 3R. Remember, the higher you aim, the lower your probability becomes, with the ADR high being the most important level in this DR model constellation. As the overnight DR session comes to an end at 8:30 a.m., you either close your position or move your stop to break even. Price reached its target before rejecting the ADR high to the tick and then selling off. This setup seems to be worth backtesting. It seems like a repeating pattern, doesn't it? Number 3, US dollar versus the Japanese yen, Thursday regular DR session trade. As I've already explained in several previous videos, the DR true percentage is crucial, and the US dollar versus the Japanese yen has some impressive statistics when it comes to the regular DR session. For this trade, the Thursday's regular DR session closed as a green DR box, followed by an immediate long confirmation. Now, when we look to the left, we see the previous ODR session highs lining up, along with some previous DR session levels from this week's price action that could play an important role. With that setup in place, we wait for a retracement. There was already a nice rejection from one of the previous DR levels, but it wasn't enough to catch an entry. However, we soon get another great rejection, and this time we also have the 1 standard deviation level in play as the next target, which offers more than 4R. This is your first bullet for the session. If this one fails, you already know where to take another shot deeper in the range. Price quickly finds its way back above the DR and reaches the target of 1 SD and continues even higher. This was a great trade opportunity that once again showcased the importance of having multiple confluences stacked in your favor. Sometimes keeping it simple is the key. Number 2, British pound versus the US dollar, Tuesday overnight DR session trade. This trade is very interesting. We started with a large overnight DR session green box, followed by an immediate long confirmation. Looking at previous price action, we see multiple DR session levels aligning with the current defining range. For now, we will focus on the upper levels, but also keep the lower ones in mind if we get a deeper retracement into the defining range. Price rejects the upper levels and quickly pushes away. This was a tough trade to catch from just one rejection, but now the interesting part comes into play. Switching to the futures price chart for the British pound, the picture looks different. Here, we can see that price rejected the ADR highs and the previous day's ODR highs to the tick, and it also reached the plus 0.5 SD level with its extension, while it didn't in the spot market price chart. Price then retraces one more time into the DR and rejects the previous DR levels again. Returning to the futures price chart, price perfectly stops at the closing price at this level. This is your entry. Since the plus 0.5 SD level has already been reached in the futures price chart, you can aim for higher targets, like the next standard deviation level of 1, for example. The ADR mid is a very sensitive level, as I've already explained in several videos. You can cover that area as well with your stop loss just to be safe if more than 3R is achievable. As the session comes to an end, you either close your position in profits or aim for your initial target with stops at break-even. This trade once again highlights how important it is to compare your setups as a forex trader with the real price chart in the futures contract. You could be missing out on crucial details like the ones I've shown here. And we're coming to the number 1 trade of last week. British pound versus the Japanese yen, Tuesday overnight DR session trade. The overnight DR session closed as a green DR box and confirmed longs with the 4:05 AM candle. A quick look to the left shows multiple previous DR session levels aligning with the current defining range, all clustered in one area, which creates a strong confluence. Price retraced and we saw a nice rejection of the IDR high and closing price, but covering all important levels would have resulted in a low risk to reward ratio, so the opportunity wasn't ideal. Luckily, price retraced deeper into the defining range and into the cluster of previous DR session levels. At this point, you should start considering an entry, placing your stop loss at the beginning of the retirement setup area. If you get stopped out, you could still think about another entry with an even higher risk to reward ratio. There we go, another high probability trade with multiple confluences aligning and ending in a 5R profit trade. Simple but very effective trades in this episode, giving you great insights into how to spot high probability trade setups using the DR trading strategy.
We're gonna take on the world.